Hello, everyone. This is Andrew Berman, and I am with NMP, and I am so excited to come to you on this beautiful Wednesday. Hopefully, it's beautiful wherever you are. I hope you had a great Thanksgiving, and I am thankful that I have an old friend of mine, Garth.
Who are
Garth,
you calling old?
okay, listen, I said that. I was like, who's going to internalize that? I know, but okay, listen,
Okay.
okay, an established friend of mine. Is that better?
Yeah, it is. And actually, I gave you a professional photo that is an old photo, which makes me look young. So I was deceiving the audience until you called me out, although my face on camera probably shows my age anyhow. So
Was that from your yearbook, your high school yearbook?
it was a little, into my college career. It was 2002. So it is a 20-year-old photo. It is ridiculous that I still use it, and I'm aware of it, but I like to make fun of it. So I've now built empathy with the audience.
That's great. I think that was actually when you were like originally first kind of digitizing the mortgage industry.
It was mortgage.com. That's right.
So let me ask you a question. And listen, I told you some of the things I want to talk about, but are you unhappy with the level of progress that we've made as an industry? And first of all, but before we go, I got to give you proper introduction. So just so we know, everyone and I think most of the people watching this are going to know Garth and they're going to know actually who Garth is. But if you're not, I mean, this is someone actually who I mean, really actually when I first discovered, I didn't discover you, but when I first learned of you, you were making some unbelievable changes in the mortgage business, things that just seemed, just so far ahead. So, Garth, tell me, do you feel, do you feel like actually let down, or like, do you feel like say that we've not come far enough? I mean, here you are, mortgage.com, you were doing some great things back then. But like, I feel like there hasn't been all the progress that we should have by now.
Well, the way I like to explain it, that it's I started mortgage.com with a precursor organization to that and started originating loans on the internet 25 years ago, 1996. So sure, I guess I was early. And certainly there's all sorts of technological advances that have occurred since then. Some of them macroeconomic or macro trends, high-speed internet, everybody having a computer, a mobile device. So there's certainly things that changed it. But it really, at that time, I was sort of focused on there could be a better way through leveraging technology to have a faster and ultimately less expensive process for consumers.
Yeah.
And 25 years later, I might be right. And I say that really the point of sales only took off about 5 years ago. We actually do a digital survey at STRATMOR where we survey the lenders every single year on how far they are on this digital continuum. We got about 50 data points on this topic. But it really wasn't until about 5 years ago that it started going. First was the point of sale, or the way you engage a customer through the application process. And of course, the COVID sort of accelerated a lot of the capabilities in the middle of the process. And then, of course, the closing process. There was really not a whole lot going on in an e-closing environment until about 2020, but it's really beginning to take off now, and a lot of it's occurring in the hybrid. So I guess I am encouraged that we are making progress, but it is still a business that is done the way I originally did it. I started as a loan officer in 1987. So it is still a local business with local relationships and local referral sources that are doing the bulk of the business, especially the bulk of the purchase business. So I'll give you the one last stat, and then you can ask the follow-up question. Over 50% of all mortgages done last year were done through Consumer Direct. That surprises people.
Okay.
Now, that's the unit number, not the dollar number, because a lot of retail is big loans, and sometimes the CD operations do smaller loans. However, it's over 50% of refi, and it's only 15% of purchase. So as we pivot to purchase, the CD lenders have had a really good run for the last few years. The big question is, are they going to be able to pivot or be successful doing purchases as well?
Well, that's great. Which Listen, I hope you don't mind. I'm going to share something. And so we got some resources, a little homework for everyone to do. Check out this article to
Oh,
prepare for the storm ahead, building your purchase business pipeline. But I want to follow up on that. So tell me, what was the process, from mortgage.com in 1996?
mhm.
What did the mortgage process look like back then? Walk us through, from application to closing, what that looked like.
Well, first of all, in 1996, it was significantly more banks. So the idea of starting an independent mortgage banker online was kind of a crazy concept because the banks were still the dominant player in the mortgage industry, and that has most certainly changed significantly, at least on the origination side. In fact, this past year was the first time ever that more mortgage volume was done through independent mortgage bankers than banks. And we've crossed over a line that is not probably likely to reverse itself in the near future, especially when you look at it. And government loans are 80% done by independent mortgage bankers. Conforming loans are 60-some% or more than 60% done by independent mortgage bankers versus banks. And now with the conforming limit increasing, it'll probably go up. And the only sort of area where banks still dominate the origination area is jumbo loans. And, so they do 85% of all jumbos, which is impressive, but that is, not exactly a rising segment as more and more conforming, loan limits moves into that higher lending tier. So I think that's one of the bigger differences. There's certainly the regulatory climate has changed, but frankly, the process hasn't changed much. Anybody on this call who's been in the mortgage business 25, 30 years can point to various changes. DU was a big change and some of the other, digital applications, but it's still a process where you spend a week up front with the customer, you quote a price, but it's sometimes kind of fuzzy. You're not sure about fees, although with TRID we have to guarantee them. There's a lot of anxiety. Then there's a month, hurry up and wait, appraisals to get done, title to get done. So we've not really dramatically changed the process. We've accelerated it in some pieces and the volume is shifted around, but it's still very similar to how it was and probably not as good as it ought to be from a consumer perspective.
There's just no more handwritten 1003s anymore.
Yeah, exactly. Well, yeah.
Which, I mean, back then you would still actually have to handwrite a 1003, even though you had one typed out, right?
That's right. Oh, yeah, sure. I mean, I started as a handwritten 1003, and then I wrote a little software program to do my own 1003s and forms because my handwriting was so bad and my processor would yell at me. And I worked for a bank, by the way, out of college. So, that was sort of my foray into leveraging technology. By the way, I'll give you sort of my stock. The two largest trends in technology since I've been in the industry, number one was desktop underwriter. So, or loan prospector for my friends at Freddie Mac. But the concept of getting an automated underwriting decision, somewhat more of a binary decision, yes or no, or refer, rather than a subjective one from a human underwriter was obviously a big change. And the second technological advancement, and this is one of my joke lines, as I said, is the dual monitor. And I say that only half joking. So like any good joke, there's a kernel of truth. When the concept is you can put an image on the left side of your screen and put a computer on your right side of your screen and stare at this document and type the data into here. That was a wow. That was like unbelievable. And now I have a dual monitor laptop, for God's sakes. The point I make on that, though, is the next foray from a technological standpoint is to strip out the stare and compare and get straight at the source data. And that's really a big part of the digital piece, is trying to get at source data in order to be able to, be making decisions based directly on the data rather than the interpretation of a human to the data that was presented in an image. So that's sort of where I think we are as an industry.
Yeah. Which can address, one of the two P's I wanted to talk to you about, which is profitability. But I want to first, going back actually onto the purchase thing, if you could actually share with us, what's, I just looked at actually the list of lenders that over the last 12 months that have been so heavy in refis. It's scary. Like and just some of these organizations, it's going to be like an aircraft carrier that just realized that there's a sandbar coming up, 100 yards away, and it's going to be very difficult for them to turn that ship. But what kind of guidance are you giving clients that maybe don't have the experience to turn that ship from the IMB's perspective? No one from the banks is going to be watching this, and if you are, I'm sorry, this is not for you. But for the IMB perspective, tell us actually what kind of insights or kind of guidance for players that haven't been through the cyclical the cycle.
Sure. So I'll give you a couple stats real quick because we're a consulting firm. We specialize in data, so I like to have charts and graphs. But the industry is expected on a unit volume basis to drop 38% in a year. I don't know which year, and I'm not sure exactly when it's going to start, but most people feel it's coming. So my analogy is it's storm clouds because I live in Florida. So not the sandbar, it's a storm cloud. I don't know if it's a hurricane, category 1 or hurricane category 5, but the storm clouds are there for sure. That 38% drop, though, is a 71% drop in refi and relatively flat in purchase. I'll give you the statistics in a more personal way for the loan officers. The average retail originator over time does about a little less than 4 purchases a month. In 2018, that same loan officer did 4 purchases a month, did about a half a refi. So they did 4.5 loans. In 2020, they did 4 purchases and 4 refis. And that's your 50-50 split. So what's going to happen? The 3.5 refis are going away. So you're going to have a refi every other month, and you better have 4 purchases. And if not, your volume is going to go down. But really, from an industry perspective, the average originator is bumped along at about 4 purchases a month, for the last several years. The really tricky thing, and this is what we advise clients on, and it's a tough one. It's what the article that you referenced in the link there. It is not just that the volume is going to drop. It's that so much a higher percent of your volume is going to be purchase versus refi. And the way I describe it is refi is easy and purchase is hard, or refi is linear and purchase is episodic. And the way I would describe that is if you talk to somebody about a refinance, you're pretty much saying, what's your current loan? 4%. Your new loan will be 3%. I can save you 1%. What's your current loan amount? $300. I can save you $3,000 a year. Are you interested in doing it? Now, not everyone's going to do the mental math maybe as fast as I do, but it's not. And granted, a good loan officer connects with them on an emotional level. What is $300 a month worth, or $250 a month, or whatever it might be? But it's not that much more complicated than that. Now, handling all those refis and juggling your pipeline is hard. In a purchase, I'm looking to buy a home. Oh, terrific. Have you listed your current house for sale? Yes, no. Has it sold? Do you have a realtor? Yes, no. Have you started looking? If you started looking, have you made any offers? Yes, no. Not really sure. Is it a really tight market where there's a boatload of offers being presented on any single piece of inventory? Absolutely. How are you going to compete on that? Not really sure. I mean, it's like, if you try to do a schematic, refi is straight and purchase goes in all these directions. And if you are not prepared as a salesperson to manage all that for a long lead nurture cycle, it's not a refi, make a decision in a week. It's going to be months of dealing with these people who are, emotional. The realtor role, the realtor can be tough to deal with. All of these things you have to deal with, or you're just not going to be effective. You have to almost forget the muscle memory of the refis. Boom, 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 and suddenly realize that you're in the real estate business again. So, and I'm not trying to offend anybody who's already been successful and is doing way more than 4 purchases a month. Congratulations. But it's tougher. It's tougher than doing refis. That's really the biggest thing of trying to get across to our clients.
So now, did you actually, when you got into the business, were you originating?
Yeah, I was a loan officer. Yeah.
You're a loan officer. Yep. How did you build your business? Like when you started day one, you didn't get your NMLS, but someone actually gave you business cards and said, "Yeah, Garth, go bring in some loans.
Kuppenheimer suit. If you guys don't remember what Kuppenheimer was. So I had my Kuppenheimer suit and my business cards. It was basically building out the realtor referral model. The biggest thing I think I figured out fairly quickly is I was young. I didn't know anybody really in the real estate business. I was starting from scratch. And I pretty quickly realized that there are, and I could share the statistic, there's 1 million realtors, literally, but they don't all do a lot of business. And the purchase, by the way, statistic I gave, the average retail loan officer does 4 purchase loans a month. The average realtor does 4 purchase deals a year. So I suddenly started doing the mental math, and said, I can't just run around and meet realtors. I got to actually meet the realtors who do the business, because if you don't get to them, I mean, it's just staggeringly inefficient. So that was really, I'd say, one of the big ones. And I worked for a company that gave us some pretty good sales training, and I think I took to it pretty well. And I was straight commission and stuck at it. So I think it's the same story, a lot of them. But finding a niche of realtors who are really doing the business and then demonstrating your value to them as a partner, I think is probably still the key, the primary way people get business in this market.
Yep. So it's still focusing on those realtor relationships, building the realtor relationships. So you don't and have you seen any of your clients, and not just your clients, and from as an observer of the industry,
right.
Good strategies to circumvent the realtor, to how do we reach the borrower directly, so we're actually the ones providing the leads to the real estate agents, rather than begging the real estate agents, please.
So, well, we work with a lot of lenders who are active in the servicing space. So those are the ones that have very high retention of their existing servicing customers. So that's a way to get the customer first. Retain the customer you've already got. If you're a bank and have an affiliated customer base, that's obviously a significant potential source of business, as long as you manage it correctly. So I think that's those segments are obviously critical. There's a lot of new digital marketing to personally brand yourself. Personally branding, as you sort of asked me, how did I start? Personal branding for me was the business card, the Kuppenheimer suit, and hand-to-hand combat. And obviously, if I was starting today, I'd be doing a lot more on Facebook and LinkedIn, and create a presence and a brand, and doing videos. And I appreciate the opportunity to do this one today. So I think there's a lot of things like it. The one thing I would say, and when we do training for lenders related to purchase, whether they're direct or retail, the biggest thing, or a thing, or soft skill that I think people forget, is how unbelievably emotional and impactful a purchase deal is. And I give you the example. If you were at a dinner party and weren't in the mortgage business, and you'd said, hey, so how are you doing? And the person said, well, I'm looking to buy a home. Would your first question be, what's your sales price? And that shouldn't be our first question either. Your question would be, wow, how come? Why are you looking to buy a new home? Well, I'm expecting a baby. Oh, that's amazing. Or I wouldn't be expecting a baby personally, but I'm moving. I want to be closer to work. I might be lamenting the fact I'm getting a divorce. There could be a million reasons, but there's never no reason. And I think a lot of lenders, and it's the muscle memory. In refi, you go straight to the transaction, because that's really the transaction. And in purchase, you have to get to their experience and what it is they're really trying to accomplish. Because otherwise, that's what the realtor talks about. So if you're going to develop the realtor relationship, you better be speaking about what matters to the consumer, and then ultimately what matters to the realtor, which is a seamless transaction that protects their revenue, their commission. So I think that's, two pieces that are, I think, often forgotten, is those soft skills around how to deal with people about what's happening in their life around a purchase, not just the transaction itself.
Makes a lot of sense. Don't make it about a transaction. Don't focus on the money. Focus on, what's your why? Why are you doing this? What do
That's right.
you what do you picture? You're like thinking in this new house, what excites you about it? The numbers will come later on. They have to, but don't lead with actually with the numbers. That makes sense. So listen, I'm going to, you mentioned pivot to purchase. We're going to pivot to profitability from
Right.
purchase. So listen, obviously technology is the that's a big place actually where we're going to be able to find some
Hopefully.
let's call it, profitability. So
So I would say here's the biggest thing I say in tech, and we actually wrote another article. My colleague at STRATMOR wrote an article about this. Be careful of the shiny object. The biggest problem that we see related to technology is, and we have a survey results on this, by the way, is lenders, and really it could be an originator too, the inability to focus on the people, process, and technology that they're trying to implement. They assume the technology will solve the problem without ever addressing the process. And they will assume that their people will just naturally gravitate and use the technology if you put it in their hands. Those two things do not happen. And I will tell you, the data is startling how dramatically different levels of adoption you see between two lenders using the identical technology. Identical. And so the only is that one of them is focused on the people and process associated with it and has reinforced the value to their constituents and, or even insisted that people use it or incented them to use it. And the other one just kind of went with the shiny toy and said, God, I installed that day one certainty asset verification thing and nobody uses it. It's like, no, that's not true. You have to sell it like anything else. You have to sell them through the process. You have to design it properly. So anything related to tech is really a people, process, and technology.
So let's dig further into that. And by the way, I got to credit Katie Jensen, who's our staff writer. She helped me actually prepare some of the questions I want that and the talking points I wanted to talk to you about. And so so how do you drive user adoption? Both internally and I guess externally for consumers, but more importantly internally, because that's what drive it. I mean, we have an event that we do called Originator Tech, because I always say happy originator, happy borrower. And I believe actually if the technology, if the originator is excited about it, they're gonna talk and they're gonna use it. But how do you sell it to the originator to get them excited about it?
Well, by the way, I'm also speaking at the Lenders One event next week on this topic in Dallas. And I only mention that because that'll be twice this month. I have to go to Dallas because the second time will be when Michigan is in the college football playoffs at the end of the month after they beat Iowa this week, just in case you can't tell my loyalties. So,
by the way, we just lost all the Buckeye fans.
Yeah, exactly. Sorry about that.
Go Buckeyes!
Yeah. I think they shut off from a PTSD as soon as they saw the block M. Sorry. All right, now I can't remember the question, Andrew. You're saying what do we tell them about adoption?
How do we get actually, how do we get how do we get users, whether they're Buckeyes or not, that get them to adopt the technology, because it's working like that. Whatever they're doing, they're like right now
works for some and not right.
Yeah,
So we just are completing a survey right now. And the survey results, when we ask lenders what is the biggest barrier to adoption of digital technologies, it is getting their internal users to use them. And in some cases, that is the loan officer, if it's, on the consumer-facing side. That is the number one. Number two, by the way, is making the technologies integrate with each other. So that second one's the vendors making the tech or the lenders making the tech work together. The first one's really just about getting users to adopt it. In some cases, though, that is because they've not been properly trained incentive or it hasn't been well designed. Yeah. So I do think it's not always that loan officers won't change. It's sometimes that their resistance to technology is a reasonable response to technology that wasn't implemented very well. So I think that's, there's a look in the mirror part of this. But the second is you've got to really be focused on what it is and what problem area that you were trying to solve. And then you have to pivot and make it consumer centric. The consumer's experience, if it drives a better consumer value and you can reinforce that to the consumer, they will adopt it. So, and even back when we were doing originally D1 certainty type work on assets, you had lenders who got hardly any adoption. The lenders will never do it. The consumer will never do it. They won't enter their username and password. I would hear that. The next lender would have up over 40, 50% adoption. Like, how can that possibly be? Well, you get to that lender who has high adoption and they reinforce the value of it. They incorporate it at multiple steps in the process. They sold the consumer on the benefit. I think you'll find that this process would work much better, and I won't have to ask you for additional bank statements. It'll only take a second. You just walk them through the process. If you do all of those things, none of which have to do with the tech, you'll get higher adoption. There's no doubt. If you skip it, you'll get lower adoption. I mean, that's what we consistently see.
Interesting. And so, and is a lot of that have to do with also having properly, staffed IT? I mean, should we be spending more on building our, our IT departments in the mortgage companies? I mean, like as we're bringing out new technology, should we be relying less on vendors? And then of course, I mean, that's now we're actually bringing in more fixed expenses, which crushes us when the volume crushes us, and we have to send hiring bonuses to hire new loan officers to replace the lost volume, and
Yeah, I think some of this is where you fit in a competitive spectrum. So there's a little bit of strategy. And I say this because if you're a big lender and you're truly trying to differentiate the consumer's experience, it ultimately is difficult to do that if you rely solely on vendor-supported tools without an internal team that manages it. It doesn't mean you have to build, but you're probably going to have to build some integrations, manage the integrations. Maybe you want to do something with bots, but it's hard to differentiate at scale unless you're going to commit some budget to do so and rely solely on the vendors. If you are a smaller lender, you may say, look, I can't commit that sort of resources. I'm not going to spend that money. I'm going to rely on the vendor part, in which case that's okay, but you better lean into that people and process part, because you're going to have technology that's probably ubiquitous that everybody else has too, but you could be better at people and process, motivation, training than the next guy. So you can still out execute, you can out hustle, you could do better with the same technology that others might have. So I don't think it's a one size fits all, because of the fact it depends on what your strategy is and how you're trying to position it in the market.
So, and what's the how do you make that decision, the build versus buy? Where do you actually, are you big enough that you say, hey, something, the POSs that are out there aren't good enough. I think actually we need this specific thing to fit with in our universe.
Mm-hmm.
Like, how does that decision come about?
It's not easy, but you need to hire a smart consulting firm that has significant experience in this area. Click the link in the chat. There's an article. Okay. We do a lot of that type of work, so I'm not trying to be completely self-promoting. But
it's important. Listen, you want to hire consultants when you're going to be investing something like this. You want to know actually, because I mean, how many clients do you have actually over the let's say like the last 5 years? How many clients have you worked with?
Oh, hundreds.
So right. I would rather actually have the experience from someone who's dealt with hundreds than me and just my experience when dealing with just my organization. So it makes all the sense in the world.
And I mean, the other is off our digital surveys alone. We have surveys from over, I think the number was 300 of the top lenders in the country on every single technology they use and how satisfied are they. So you can also look at the ones and say, it doesn't mean you should always take the one with the highest market share or whatever. But we have the data that says, well, their customers tend to always be larger independents and you're smaller independents, and maybe that's not the right fit for you. It doesn't mean that whoever ranks the highest is always necessarily the best, but we have the data at least help you make an informed decision. And it's a lot better than probably trying to take 10 demos of every technology and figure it out yourself.
Yeah.
Right.
That makes sense. All right, so listen, I want to talk about M&A because listen, as things start to get thin for mortgage bankers, and
Yep.
as they're not able to turn the ship, and they see that storm coming or the sandbar coming, with whatever it is, how do I, the opportunity might be to, for merger and acquisition. I mean, merger is
Sure.
really very rare. There's a merger, actually. It's usually an acquisition because one company's strong, one company's weak. But talk to us. Who do you feel are going to be like the companies that are going to be good acquisition targets?
Yeah, so I mean, I'm going to rattle off, I guess, some quick, because I oversee all the M&A activity we have at Stratmore, and it's substantial. In 2018, when the average mortgage company made less than 10 basis points, there were about 33 IMB consolidation deals, so a little less than 3 a month. In 2020, when the average mortgage company made over 100 basis points, there were 15. So what's the difference? In a good market, the companies keep rolling the dice, doubling down. 2021 will be more than 2018. It will likely going to finish the year at about 30, somewhere between 35 and 40 deals. And like I said, 2018 was 33, and 2018 was a rough year. So why the heck, off a year where the average mortgage company kind of made about 100 basis points, why are we having such M&A activity? And it's really that everybody sees the storm clouds, but there's two completely different camps who both are making very reasonable decisions based on what they see. The buyers have spent a lot of money on technology, marketing, branding. They're very strong. They're big. They have good capital markets expertise, and they want to grow into a down market. They know their refis are going away too. So to grow, they want to acquire loan officers or acquire production, and they're willing to pay for it. So that's how they see the storm clouds. They don't want to wait. They want to grow into a down market. Meanwhile, on the sell side, you have them staring at the same clouds and saying, okay, I had a great year, the best year ever, put a lot of money in the bank, probably more than I ever expected. So do I want to start putting my personal capital back into the business to try to preserve my market share and fight the beasts that are in buy mode? And it is a perfectly reasonable decision to say, yes, I can do that, as long as I'm prepared for 2018, which is a year in which I probably didn't make any money or not a lot of money.
Yep.
That's okay. You're going to ride it through the rough spot. But there's a bunch of sellers who are saying, I'm ready to, take my chips off the table, be paid a reasonable premium for what I built for my company, and would rather be a, small part of a bigger dominant player. That's really what's driving the M&A. And I'm not saying it's all the biggest lenders are the buyers, but it's mostly independent mortgage bankers buying smaller independent mortgage bankers and trying to grow into a down market. And it's a very hot market for that reason, because you have that rare time when the numbers are aligned and the buyers are willing to pay very reasonable premiums, and premiums that would make a seller, it would be attractive to perhaps consider an exit.
And by the way, I want to flash up. This is a good article that Garth wrote. It's on. You should see that right there. I'll drop it in the chat too.
These articles are important because it proves that I can actually write things without jokes. Thank you.
That's good. All right, fantastic. So yeah, check that out. And so let's talk about, actually. So let's say I'm an independent mortgage banker. Things are just getting rough. And listen, I remember 2018. Like, there were companies that were just saying, listen, just give me the money I have in the company, and I would be happy. Like, they just let me take out my net worth, so you can come in and I can walk away. And that's what people are happy for. But what can companies do now to kind of prepare themselves, to be an acquisition target?
So there's a few things. Generally, the way that we interact with companies on this basis, first of all, is highly confidential and extremely non-disclosed. You do not want to put a for sale sign in the front yard. And you need to be very, very careful, because the value of a retail mortgage franchise is embedded in the team that's been built. So we are unbelievably sensitive about trying to work in a very, confidential manner with potential sellers to explore their options. So exploring the option should not be, well, let me get a few purchase bids and then I'll see if I want them. We like to do that type of work and give people a valuation of what we think that we could get for their company. And in many cases, when we talk to sellers and they say, we go through a process, like, are you really serious about this? Is this what you want to do? We go through a big sort of model, understanding of their model, the strengths and weaknesses. We act almost like a buyer. So we'll say, look, this is what a buyer is going to see. They're going to ask these tough questions. We vet it pretty carefully up front before they ever stick any for sale sign. So I think that's the right first step, is a good confidential for anybody who thinks of it. And it's really about coming up with a valuation for the business. What is my business actually worth? And a lot of times the sellers will say, look, I don't really want to sell, but it's for estate planning purposes, for tax planning purposes, for how do I answer when my wife or husband asks me what my company's worth? It's good for that as well.
Yeah.
So that's usually the best step. And then if somebody's serious about it, we are sharpshooters. We're not infantry for the exact same reason. We don't believe it's best served to, put a book around, like the tech companies will float books to try to sell themselves, but their value is embedded in what they've built in code and things like that. So everybody kind of knows the software companies might be for sale. Mortgage companies got to keep it, small, find maybe very few buyers that would be attractive to you and your model. And then perhaps if you're still ready and like to do it, then you engage in a process with them on a confidential basis. That's what we recommend.
So, and obviously, you have a firm that's built actually an entire strategy around this, but give us an overview. Like, how do you calculate a mortgage company's worth, assuming there's no servicing portfolio? Like, how do you, is there,
Sure.
Is there significant value to licensing, your Fannie Freddie ticket? I mean, how do you actually, come up with the value?
Transactions, by the way, are completed either as an asset or a stock deal. If it's a stock deal, there is potential value, potentially in Fannie Freddie tickets and licensing. If the buyer doesn't have those licenses, if they already have all that, then there's kind of no value at all because they got it. So that you have to understand the vagaries of that, and whether your corporate structure, C Corp or LLC, you can factor into what might work better for you.
Wow.
But having said that, it really is. Normally, I would answer the question until this year of saying that it is a projection, is what is your cash flows that you can generate over the next 3 to 5 years from your business? What is that worth for somebody on a discounted cash flow basis today? Meaning, what would they pay to get access to the cash flows that are based on the loan officer's ability or the company's ability to continue to generate this volume? That's the normal answer. The other thing that's happening right now is comparable sales. So it is as if, and because, if I go back to there's 15 deals a year, that means there's a sale every other month. So, how many mortgage companies were sold in the previous few months normally is only a couple, and maybe they're not comparable. So it's a real art form. Well, right now, it's comparable sales. Like, we got offers on companies the week before Thanksgiving, so that's as recent as I have. I'll probably have some this week. So the market is a little easier to define right now because there's so much activity.
Yeah,
but one thing
value.
Yeah, 2018, you keep mark. You mentioned the no premium, right? Not being paid right now. Mortgage companies are getting premiums for their business. A premium meaning a upfront amount of money in excess of their balance sheet, plus, of course, they get their balance sheet. So they're not just taking their money off the table; they're going to get paid a premium for a well-run mortgage operation right now.
Oh, fantastic. Listen, Garth, I have so much more I got to talk to you about. We could be here for hours. We got to do this again.
All right.
I really appreciate you taking them. There's more things I want to ask you about M&A. I'm sure actually, our readers. I think actually we're probably gonna have to do a follow up. Do this again because you just have you have an unbelievable understanding of the industry, and just an uncanny ability to get data together. But
appreciate that, Andrew.
I thank you so much for taking the time today to join us and join our readers.
Got it. I appreciate that, and go blue.
Yeah, fantastic.
Right.
And everyone, thank you for watching another Mortgage Leadership Outlook. We go live just about every Wednesday, and we look forward to seeing you again next week. Have a great day.